Let's also get in David Pazarkar, head equities at Daiwa AMC, to throw more light as to what the scenario for the Indian markets is. David, morning. Thanks very much for taking the time out and being with us. To start off, what do you think the Indian markets are looking at as a trigger point, given that the political uncertainty continues to persist? You did have the moves by the ECB as well as the US Fed. That has substantially reduced the risk premium for equity investors across the globe. But what do you think will take precedence going forward now?
Good morning and thank you for having me. At least in the immediate near term, it's going to be earnings and either earnings positive surprises or earnings disappointments, which are going to move stock prices. So that is likely to continue at least for the next couple of weeks. On the aggregate, what we have seen for the Indian market is that we have seen a net number of upgrades compared to stock downgrades, at least for this quarter. Although in terms of EPS numbers, there have not been too many upward revisions. But in terms of stock recommendations from the sell side on an aggregate, we have seen upgrades. However, if you compare that with what has been seen in the US or even in Europe, at least this particular quarter has been a sort of a disappointing quarter. So we have some global headwinds and some uncertainty there. On the other hand, it seems as if the Indian earnings cycle has sort of troughed, and at least as far as the cyclicals are concerned, we might see some earnings upgrades, particularly for the companies where a lot of government intervention is
David, I hate to interrupt you there, but I'm afraid the reason why I'm interrupting you there is because you're not giving me clear answers. Is it time to buy? Is it time to sell? Are you bullish? Are you bearish? Are you confused?
No, we are optimistic, and we would advise investors to remain 100% invested into equities. The primary reason being that there is still a lot of skepticism as far as the reform process is concerned, and we think that level of skepticism largely will result in stocks giving positive earnings surprises. So I think it would make sense to remain invested and look at stocks where the earnings upcycle might be driven because of the economic upcycle. So stocks which are related to the economic upcycle, which might happen starting next calendar year.
Is it too early to bet on that thesis? Because if I look at numbers from BHEL, Crompton, Greaves, or for that matter, any of the machinery companies, the basic harbinger of which way the investment cycle is moving, these numbers have been poor. The management commentary is also not strong. And my understanding with corporate India is that corporate India, at least the private guys, are not ready to commit when it comes to any capex.
Absolutely right, Nikunj. What I would think would be a better bet would be to look at the banking side, particularly public sector banks. There is a lot of skepticism, and completely warranted, because the asset quality has been poor, and we are prone to seeing negative shocks there. But I think if you are looking at a situation where domestic earnings, and I would not want to look at stocks which are exposed to international operations. If you're looking at the domestic situation improving, then I think public sector banks are a nice proxy. But yes, there is a possibility that this trade could be a little early, maybe a couple of quarters early. But we have safety in terms of reasonable valuations. Although if you look at the overall balance sheets, there are they are sort of impaired. But I think it would be a fair trade with a 6 to 9 month kind of a view. So public sector banks is one sector which investors with some risk appetite could look forward to.
David, what would be your view on the defensives, the pharmaceutical as well as FMCG? Remember, they are those secular growth sectors, but they seem to have defied gravity of late. Do you see the up move continuing?
Well, at least as far as the FMCG is concerned, I would think that the valuations do not offer any incremental comfort. It would make sense to look at individual stocks, and I think we would, at least as far as our portfolio is concerned, we are looking at the second-tier FMCG companies, which are still showing strong organic growth, and where the valuations have not, have still some catching up to do. As far as the pharma companies are concerned, we are overweight that sector, and I think we would see earning surprises from most of the pack there, at least for the next couple of quarters. And given the fact that we are going to see strong earnings from this sector, I think the pharma sector is reasonably priced. So we are actually overweight the pharma sector.
Why are you overweight on pharma? Because if I look at pharma valuations, most of the pharma companies are trading in the PE band of about 20 to 25 times, which is some kind of a premium to the Sensex. Also, given the way how currency has moved and the fact that the US generic space is getting extremely competitive, one can argue that the springtime for Indian pharma stocks of Indian pharma companies could be behind us.
Well, that argument is definitely valid, but I would think that that generic cliff, as it is called, is at least a couple of years away. We still have at least 2 strong years of strong genericization and very robust earnings. Indian pharma companies have penetrated almost all across the globe, and they are just seeing their sales starting to pick up there. They're just seeing their incremental market shares going up. They have built in very strong pipelines. So I think at least for the next 2 years, we will see strong earnings growth. Unless we expect the rupee to appreciate to around 45, 48 kind of levels, I think the rupee level also remains sort of comfortable. So, given all these factors, if you look at the forward earnings multiples, they are in the range of 17 to 20 for most of the companies. There are, of course, some companies with extremely strong earning streams, which are also trading at around 25 times. But for the most of the pack, we feel the earnings are in the range of 17 to 20, which is a fair multiple. Of course, these stocks are not undervalued. You are absolutely right. But we think that if you look at the earnings consistency and the fact that the FMCG sector, which is the other alternative defensive choice available, is trading at much higher valuations with a possibility of their earnings sort of slowing from here on. So I think given these 2 factors, we would tend to bet on pharma rather than FMCG at this particular point of time.